The numbers came in very solid, about 12%, when about 4% was expected. That's part of the reason you had that torrid run in the market, because the earnings were just solid and coming in. As a result of that, the first half of the year came in much better than expected, lowered expectations for sure, but lowered to a point where it matched why the market dropped so much, in March and April. And so you're having numbers also moving higher for the rest of the year. I think what's not talked about, actually, what's going on in the financial sector. I mean, numbers are going higher there. That's not reflected in Nasdaq, and that's part of what the run has been about, has been financials as well. We spend a lot of time talking about tech, bright, shiny object. Everybody owns them, so therefore vulnerable. But financials have been terrific also, as well as industrials.
You mentioned, I see in just kind of your sectors, utilities and industrials. Is that kind of the, bringing stuff back to America, manufacturing and just kind of all that stuff?
It's the data center build out. The data center build out. Of course, if the Fed is cutting, utilities will do well also, simply on the interest rate play. But we're really looking at a structural change in the U.S. economy where capital is flowing. I think what hasn't been talked about is the one big beautiful bill. We talk about tariffs night and day, but we haven't talked about the incentives buried in the one big beautiful bill for data center build out for capex and investment in structures. In the most recent earnings season, 275 companies mentioned that the tax provisions within the bill are going to be positive for their earnings and for their businesses. And that has really been under the radar in a sort of a shocking way. It's part of the reason numbers are moving higher.
Alicia Levine with this Bank of New York, BNY, thrilled that she could be with us today. The problem I have with the gloom over the build-out, obviously it's an unknown. We really don't know about it, is essentially with the profit generation of these companies, a portion, if not all, of their capex, it's a rounding error, but it's not that big a deal. We don't understand the scale of their profit.
So there is so much cash flow and profit in these companies. The scale of the capex this year, it's about $370 billion. Very interestingly, that's also the tax benefit from the one big beautiful bill in 2026, about $400 billion. It also equates to the tariff hit, which is a tax of $370 billion. So they're offsetting each other, right? The tariff hit, which is a tax, and the spending that these companies are doing. So there was a reduction in free cash flow margin for the Magnificent Seven because of that. But ultimately, these companies can handle it, and their margins remain high. So in a sense, you're getting paid to wait to see if this works.
I mean, Paul, this is not 1999. You and I keep saying that.
Yeah, having been there in 1999, pumping out those companies back in the day. Alicia, what do you think the Fed should do for the remainder of this year going into next?
So I think they will cut.
Okay.
I think they'll cut 25 basis points in September, because ultimately what's happening in the labor market will outweigh what's happening on the inflation front. The bump in inflation, for the most part, we've heard from the Fed, is going to be, they don't say it's transitory, but they're saying it's transitory. One-time hit is the same as transitory. A slowdown in the economy is not something that the Fed's going to be able to stomach, and the labor market is now at a lower equilibrium rate. Harder to play with that, right? If your equilibrium rate on hiring is 100 to 120,000 jobs, and now you're down to something like 50 to 70,000, you just don't have as much margin for error. So they're going to cut, and they've taken hikes off the table. So the Fed is cutting, the market's near all-time highs, the economy is getting this bolus of investment into the AI infrastructure and in industrials.
Right.
So we think you have a cyclical upswing. The PMIs have not caught up yet. We think they will.
I got to get two things in here. The first one is the basic idea of investment for our viewers and our listeners is simple. I'm in it for the long haul. How do you look over the horizon to 26 or 27 right now?
Look, we always have a 12 to 18-month horizon. And even the scare of, let's call it early April, is something that our clients in BNY Wealth are well used to. If you think about the last 10 years, we've had 5 20% drawdowns or more, and every single one of those times have been an epic buying opportunity. So the long haul is you add when you can, when you have liquidity or cash, and you don't sell, because you always sell at the low, always.